Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, March 24, 2015. Inside the numbers tonight, we'll talk about our slick oil trade. We'll talk about the Spider and the Emini. We'll talk about crude oil again. We'll talk about gold, interest rates, the bond market, and the dollar. Real quick, I want to go over the oil trade. So let me just go over to the actual crude contract itself. And the reason I want to go over it is because I have a trade alert out to members, and everybody should know that early on today, the market made the attempt I was looking for. It just didn't get up as high as I was looking for, and that's why I sent out an alert early to protect your capital, protect your stops, raise your stops, take some profit, whatever your trading strategy for whatever your needs are. But, early on today, we were, even before 9 o'clock in the morning, which, this is trading on the electronic session, this was up at 48.56. 48.56. I was looking for 50 today. And the fact that it didn't happen today and we went up this high in the morning and never challenged that high again this afternoon or the rest of the day, in my mind and my work and the way I analyze things, reduces the probability that we're going to see 50 when I said we would see it, which was early this week. Okay, this was a quick trade. It was set up that way. We took an attempt this morning, and hopefully, some folks took some profit off the table. But in terms of what I think the probabilities are that we get to 50 tomorrow or even the next day, it's reduced from what it was when I put the trade alert out on Friday. So just want to make mention of that. Let's go over to the Spider, and we'll talk about the market, stock market. And the market was weak today, and what this is telling me is the market wants to go a little bit lower. And whether or not it happens, another 2 or 3, 4 days in a row, or we have an up day tomorrow and then a down day on Thursday, or, any combination, doesn't matter. All I'm saying is that the probabilities are that we're probably going to see another 20, 25 points lower in the S&P 500, $2 to $2.50 lower in the Spider, and 20 to 25 points in the S&P E-mini contract. And how that happens, it really doesn't matter, because this is going to be a buying opportunity. Whether it happens Monday or Tuesday or tomorrow or Friday, doesn't matter. All we're looking for is a buying opportunity. And how are we going to know where that is and where we're wrong? Well, that's a great question. So let's go figure it out. All right. So there's a pretty easy way to do this based on where the market is now and the range we're in. Okay. The range is basically the high from back here. Okay. This is the range. We're in the high is the top end of the range. And right now we're going to make our low, the low closing basis of 206.62. On the SPY, 206.62 is going to be our line in the sand. Any close on a daily close below 206.62 is going to change the probabilities that the market is in a short-term bullish fashion, which meaning within the next few days. Okay, so as long as we stay inside this day here, that's all I'm saying, on a closing basis, then I think this market goes higher. If we close below that, we may test some lower levels, and that's how we'll play it one day at a time. Okay, same goes for the E-mini. It's the same routine. There's no difference. It's basically this day here. So we're looking for a 2052. As long as the market closes above 2052 for the time being, that's your downside maximum, and your upside is going to be 2107. 2107 on a closing basis, or call it 2108, is going to be the beginning of a breakout. And that's how we're going to play the E-mini contract. Tonight's a good night to talk about our market tell, right? The IWM. I haven't talked about the IWM in a little while. The IWM was up today. S&P was down over 0.5%, was down almost 13 points. Dow was down 100. about 0.5%, and the NASDAQ was down. So IWM was up. What does that tell us? It tells us that there was money flowing into risk assets, okay? Market goes up, money flows in. Market goes out, money flows out. Or market goes down, money flows out. It's pretty much that simple. So money was still flowing into the small cap or Russell 2000 index, which means that, at least to me, that the longer term picture, and when I say longer, I'm not looking out a year or two, I'm saying, weeks to months, is bullish, okay? Bullish. All right. Let's go over to the gold market, okay? This is the GLD. Had a little update today. Not bad. And, we're getting a little follow through, but we're going to get a stall out. Well, let's actually go over to the gold futures contract, because last night I mentioned that 2195 to 1200 is going to be a resistance area. So today we got to 1194.90. So 1194.90 on the high today, 1195 to 1200 was the stall out point. So we'll see what the next couple of days brings. But any pullbacks in gold, especially if you get a pullback into like the 1175 area, is to be bought. Unless we convincingly close below that area, then I'll reassess. But remember, as long as we stay above this channel line, then the market's going to remain in a bullish fashion as far as I'm concerned. And that's really all there is. The GDX was a little weaker today. If those of you that followed the GDX, let's just bring it up real quick. I know some of you like me to talk about this periodically. And GDX was down a little bit today, but not much. And it was just drifting down with the market. I mean, the reality is the GDX is made up of a bunch of miners. And when the price of gold goes higher, the miners, by sheer the fact that they're selling a product that has a market price on the rise, they're just more valuable as a company. The higher gold goes, the more their inventory is worth. It's pretty much that simple. So normally any substantial move up in the price of gold would pull the miners along with it eventually. But day by day, they don't have to trade in tandem day by day, because there are certain days when the miners will just get pulled down with the stock market because they're stocks. And that's what happens. So let's go over to the oil market, and we'll just kind of cover a little bit more of the oil trade. So, I gave you my thoughts on the probabilities of 50 at this point. It's just reduced. It's still it's still out there. It's less likely than it was the other day. That's all. It's the underside of this channel here, and if we don't get there and we fail, then we're going to go lower once again. And ultimately, whether it's after this move or if this move's over and it could be on the next move, ultimately we're looking at the mid-30s for oil, and that's going to happen this year, and it's most likely going to coincide with a much stronger U.S. dollar, which we'll talk about in a few minutes. And for those of you that like pair trades, that would be an interesting pair trade. It's got no rhyme or reason for most analysts out there, other than the fact that I believe they're gonna move, not necessarily day by day, but over the longer term. While this is unfolding, I think crude oil will move inverse to the dollar and vice versa. And I think that you're going to see lower prices in crude oil, higher prices in the dollar throughout the remainder of this year, maybe even into the first quarter or so of 2016. And short oil, long the dollar would be a longer-term trade that should play out. Let's go to the bond market, and we'll talk about TLT. And TLT, our buy zone was 124.25, and it's still going higher. So anybody still in this trade, just trail your stop. Let the market take you out when it decides to pull back. We don't have to guess when the market's going to pull back. Is the market going to get much higher than this zone here? I don't know. Probably not. But this is still up there. And could we stall out right here tomorrow? Yeah, of course we could. But if we don't, I want to participate. So, let the market take you out on a trailing stop and just let it happen. I mean, who makes 7, 8, 9% in a few weeks in the bond market? We do. Okay, let's go over to the dollar. Here's the U.S. dollar, and we came close to the buy zone today. And, on days like today, you kind of look at that, and it had a low of 96.57, and this zone is basically, 96 in that neighborhood, 96 and a quarter. And you say, oh no, did I miss it? Is this bottoming? Is it ever going to come down again? I don't know. I think it may, but I don't want to miss it either. So I'm paying very close attention, and I just don't think that it's going to just bounce up from here. I do think that it's going to come into this buy zone, because don't forget, whether it's the S&P, the dollar, the bond market, gold, oil, it doesn't make any difference. Any stock, doesn't make any difference. The markets normally are designed to fake us out. They normally do the other thing before they're going to do the thing they're going to do. And that's just the way it is, okay? That's how people get emotionally whipped out of the market. They get whipsawed. That's how people do the wrong thing at the wrong time. They buy at highs, sell at lows. It's all because the market is designed to fake us out. And so whenever I look at a chart like this and I say, oh no, it came close to the buy zone and it just didn't get there, but we were only, ticks away. And I say to myself, well, that could be one of those instances where the market's just trying to fake us out, and then it'll come back in the buy zone, and then I'll feel like a fool. So I'm going to be patient, and I'm going to look for the buy zone. And if I get another indication, we'll act on it then. But I like to make money with higher probability. So sometimes that means less of a gain, but higher probability. And I'm 110% fine with that. And with that, I think we're going to end it there. I appreciate everybody tuning in for another episode of Common Sense Market Analysis. I'm David Frost, and we'll see you on the next go-around. This was Common Sense Market Analysis.